Hello, and welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5, one line of code at a time. I'm your host here at AlgoBot, and in today's lesson, we're studying an expert advisor called Engulfing Rebound Hedge. This is a pure price action system. There are no moving averages, no relative strength index, and no oscillators at all, just candles and a rolling pivot. By the end of this video, you'll understand how it frames the market, how it reads engulfing candles around support and resistance, and how its built-in hedge is designed to manage an open position. Let's get started. So what exactly is the Engulfing Rebound Hedge Expert Advisor? At its heart, this is a price action strategy. That means it makes its decisions purely from the shape and position of candles, without relying on any traditional indicator. There are no moving averages, no relative strength index, and no average true range calculation anywhere in the logic. Instead, the strategy builds its own map of the market using something called a rolling pivot. A rolling pivot takes the highest high, the lowest low, and the most recent closing price over a window of past candles, and from those three values it calculates a central pivot point, a resistance level above it, and a support level below it. Unlike a traditional daily pivot that stays fixed for the whole session, this one recalculates on every new bar, so it constantly adapts to the most recent price behavior. Once that framework is in place, the strategy watches for a specific candle pattern, the engulfing candle. It then reads that pattern in two distinct ways, which we'll explore in detail shortly. In terms of its natural habitat, this approach is designed with liquid markets in mind. Think major foreign exchange pairs, or a metal like gold, typically on the 5-minute to 15-minute charts, where short-term rejections at these rolling pivots happen frequently. Who is this style suited for? It's aimed at traders who are curious about systematic, rule-based price action, and who want to understand how support, resistance, and candle patterns can be combined into a fully automated system. Remember, everything here is shared for educational purposes only. It is not financial advice, and like every trading strategy, it carries real risk. Losing trades are a normal and expected part of the process. Let's walk through the mechanics step by step. On each new bar, the strategy first measures its rolling pivot. It scans back over a number of closed candles set by the PivotLookback parameter, which defaults to 20. Across that window, it finds the highest high and the lowest low, and it notes the most recent close. From these, it computes the central pivot, then a resistance pivot called R1, and a support pivot called S1. At the same time, it adds up the range of each candle, the distance from high to low, and divides by the count to get an average bar range. This average range is the strategy's homegrown measure of volatility, and it replaces the job and indicator like average true range would normally do. Next, the strategy inspects the two most recently closed candles to see whether they form an engulfing pattern. A bullish engulfing happens when a down candle is followed by a larger up candle that opens at or below the prior close and closes at or above the prior open. A bearish engulfing is the mirror image. Now comes the decision. The strategy looks for a long entry in two situations. The first is a rebound, a bullish engulfing whose combined low dipped down to or beneath the support pivot, S1, but whose close finished back above it. That signals a rejection of support. The second is a breakout, a bullish engulfing that closes above the resistance pivot, R1, for the first time. The short side is a perfect mirror. A bearish engulfing that pokes up to or above R1 and closes back below it signals a rejection of resistance, while a bearish engulfing that closes below S1 signals a downside break. When a position is opened, the stop-loss distance is set to the stop multiple parameter multiplied by the average range, defaulting to 1 times that range. The take profit is the TP multiple parameter times the average range, defaulting to 1.6. Both always respect the broker's minimum stop distance, so the order is never placed too tightly. Finally, there's the hedge. If an open trade moves against the position by the hedge trigger multiple times the average range, the strategy opens a single opposite side hedge, sized by the hedge volume multiple. From there, the individual stop and target levels on each leg resolve the cycle, and any leftover leg is then closed, so the next cycle always starts clean. The strategy considers a new entry only once per bar, and only while it is flat. Let's look at the actual MetaQuotes language code that runs inside MetaTrader 5. At the top, we have the input parameters. PivotLookback sets how many closed bars build the rolling pivot. Stop multiple and TP multiple scale the stop loss and take profit from the average bar range. Hedge trigger multiple sets how far the trade must move against the position before the recovery hedge is opened, and hedge volume multiple sizes that hedge relative to the primary order. Lots is the base volume, and magic is the identifier the EA uses to recognize its own trades. Just below, you can see the rolling pivot math. The central pivot is the average of the highest high, the lowest low, and the last close. From that, R1 and S1 are derived. Now look at the long block. The Boolean long reversal is true when we have a bullish engulfing, whose pair low reached the support pivot and whose close finished above it. The long breakout is true when a bullish engulfing closes above R1 for the first time. If either is satisfied, the code reads the current ask price and calls trade.buy, placing the stop below the entry at stop multiple times the average range, and the target above it at TP multiple times that range. The short block is the exact mirror. The short reversal becomes true on a bearish engulfing that rejects R1, and the short breakout becomes true when a bearish engulfing closes beneath S1. The code then reads the bid price and calls trade.sell, with the stop placed above the entry and the target below it. Both sides are deliberately symmetrical, so the strategy treats rising and falling markets with the very same logic. Now let's bring this to life on a chart. What you're seeing is an illustrative example on a pair priced around the 1.08 region, similar to the euro against the US dollar. I've drawn 3 horizontal lines that the strategy recalculates on every bar. The support pivot, S1, near 1.0832, the central rolling pivot in the middle, around 1.0863, and the resistance pivot, R1, up near 1.0895. Watch carefully how the candles interact with these levels. We begin on the left with price drifting lower. The first few candles step down, each closing beneath the one before, carrying the market down toward that lower support pivot. As we arrive at the support pivot, a down candle prints, and that becomes the first half of our pattern. Then comes the key candle. A strong up candle forms that completely engulfs the previous down candle. It opens below the prior close and closes above the prior open. Notice that its low dipped down to and slightly beneath the support pivot, S1, but its body closed firmly back above it. This is the rebound the strategy is built to detect. Support was tested and rejected in a single bar. On this candle, the buy entry marker appears. At the same moment, the strategy places its stop just below the low of that engulfing pair, and it sets a take profit target above. Because the default take profit is 1.6 times the average range while the stop is 1 times that range, the target sits farther away than the stop, a reward-to-risk profile of roughly 1.6 to 1 on this setup. It's worth noting the strategy could also have gone long a different way. If that candle had instead closed above the resistance pivot for the first time, it would read that as a breakout. Here, the cleaner signal was the rejection at support. From there, watch the market climb. The next candles push higher, one after another, as buyers stay in control. Price travels up through the central rolling pivot and continues toward resistance. As it approaches the resistance pivot, the take profit target is reached, and the long trade closes in this illustration. That completes the first half of our example, a textbook support rebound. Now the market gives us the opposite scenario. Price is pressing right up into the resistance pivot, R1. A bullish candle pushes into that zone, and then our second pattern forms. A bearish engulfing candle appears. It opens above the prior close and closes below the prior open, and crucially, its high pokes up to and slightly beyond the resistance pivot before sellers drag the close back down beneath it. Resistance was tested and rejected. This is where the sell entry marker appears. The strategy places its stop just above the high of that engulfing pair, and it sets its take profit target below, again at that 1.6 to 1 profile. Then the move unfolds. Candle after candle steps lower, back down through the central pivot, as the rejection at resistance plays out. Price works its way down until the take profit target for the short is reached, and the trade closes in this example. So in one clean sequence, you've seen both sides of the engulfing rebound hedge. A long taken on a bullish engulfing rejection at the support pivot, and a short taken on a bearish engulfing rejection at the resistance pivot. And remember, had either trade moved sharply against the position instead, the hedge logic we covered earlier would step in to help manage that open exposure. Each setup is symmetrical, rule-based, and framed entirely by those rolling pivots. And that brings us to the end of our breakdown of the Engulfing Rebound Hedge Expert Advisor. Today we covered how it builds a rolling pivot from recent candles, how it reads bullish and bearish engulfing patterns as rebounds or breakouts at support and resistance, how its stops and targets are scaled from the average bar range, and how its hedge is designed to manage a position that moves the wrong way. As always, this video is educational content only. It is not financial advice, not a recommendation, and not a solicitation to trade. Every strategy carries risk, and losses are a normal part of trading. If you found this analysis helpful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment telling us which expert advisor we should study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.